So imagine going out for this like massive, lavish dinner. The food is absolutely incredible, the wine is flowing, and at the end of the night, the waiter hands you a bill for $8,500.
Oh, wow. Yeah, that's a heart-stopping moment right there.
Right. And just as you start to panic, the federal government steps in and generously offers to help you out, by leaving a 3% tip.
Right.
And the rest of that massive bill, that falls entirely on your family to pay before they can even leave the restaurant.
It sounds totally absurd when you frame it like that. I mean, a 3% tip. But financially speaking, that is exactly what the government safety net looks like for end-of-life costs here in the U.S.
It really is. Okay, let's unpack this. Because it is wild how meticulously we plan for literally everything else in our lives,
Absolutely.
Like you plan out a 2-week vacation to the absolute letter, the flights, the hotel, the dinner reservations, all mapped out months in advance. We spend decades engineering our retirement accounts, adjusting portfolios, agonizing over college funds.
Yeah, we really do.
But when it comes to the one absolute undeniable certainty in every single human life, crickets. We completely ignore the checkout process.
We do. I mean, we meticulously engineer how we're going to live, but we leave how we're going to exit entirely up to chance. And it is a fascinating and, frankly, a very risky psychological blind spot.
For sure.
It's deeply rooted in, just how uncomfortable we are with our own mortality. People just don't want to think about it.
They really don't. And that is exactly the core of our mission for you on this deep dive. We are looking at the stark realities of life insurance and end-of-life financial planning, specifically tailored for people over 60.
Right.
And we are pulling our data and all these insights from a really comprehensive guide and informational brief provided by Gruene Insurance Group. And the central question we are exploring today, the one that paralyzes people from even looking into this, is simply, is it too late?
Which I have to say is a very natural fear. You hit a certain age, maybe you've had a health scare or two, and you just assume, well, I've aged out of the system.
Yeah, they think the ship has sailed.
Exactly. But we are going to completely dismantle that assumption today. Because looking at this data, this isn't a morbid conversation at all. It is a highly practical, empowering strategy for preserving your legacy.
Yeah.
It's essentially a final act of love for your family.
I love that framing. To get there, though, the Gruene Insurance Group research points out that we have to fundamentally shift our paradigm. Because, when you're in your 30s or 40s, the whole point of life insurance is income replacement, right?
Yes, exactly.
If the worst happens, your spouse still has to pay a 30-year mortgage and put 3 kids through school. But after you hit 60, the goalpost moves entirely. It's no longer about replacing 3 decades of earning power.
Right. The goal shifts from income replacement to crisis prevention. You are no longer trying to simulate an ongoing salary. You're trying to prevent a sudden, massive, and immediate financial burden from landing directly on the shoulders of your family.
Oh, man. And at the worst possible time, too.
Exactly. At the exact moment, they are entirely emotionally compromised. Because the financial reality of what happens within the first 48 hours of someone passing is drastically different from what most of us assume.
Oh, the assumptions are so dangerous. Let's look at the brutal math here, because the hard numbers from the source are just staggering. We mentioned that $8,500 dinner bill earlier.
Yeah, the average.
Right. The average cost of a traditional U.S. funeral in 2025, assuming a standard viewing and a ceremony, is $8,500. And that's just middle of the road. If you want a full-service burial with a vault, the numbers quickly climb to $10,000 and easily jump over $21,000.
And, the immediate defense mechanism I usually hear when I share those numbers is, well, I don't need all that. I don't want a fancy burial. I'll just be cremated. That's the cheap route.
Oh, yeah. People say that all the time.
All the time. But the data doesn't support that assumption at all. A full-service cremation with the viewing averages over $6,200. Yeah. And even if you choose a direct cremation, which means absolutely no ceremony, no viewing, just the bare bones logistics of the process, that still averages around $2,200. It is a significant immediate expense that demands liquid cash no matter which route you choose.
And here's where that 3% tip analogy comes back in. Because people naturally assume there is some kind of systemic safety net for this. But the brief lays out exactly what that safety net actually provides. And Medicare covers exactly $0 of funeral costs.
Zero.
Your coverage literally evaporates the day you pass away.
And what's fascinating here is how deeply ingrained the Medicare misconception is in the public consciousness. Families are constantly blindsided by this.
Wait, people really think Medicare covers this? Like, they sit there thinking Medicare is going to write a check to the funeral director.
All the time. I mean, psychologically, it makes a kind of flawed sense, right?
Yeah.
They assume that because Medicare covers extensive, incredibly expensive end-of-life medical care, it must naturally extend to the immediate aftermath. But it absolutely does not. And because nobody talks openly about these hard logistical numbers, families only discover this reality while they're sitting across a desk from a funeral director, already grieving, suddenly realizing they have to write a massive check they weren't prepared for.
That is genuinely terrifying. And then you look at Social Security. I mean, when I first read this part of the source material, I genuinely thought there was a typo.
It's shockingly low.
It is. Social Security provides a one-time lump sum death benefit of exactly $255. $255. That's it.
Yep, it's the reality.
If your funeral is $8,500, the government is handing your family a check that covers roughly 3% of the bill. The other 97% falls instantly onto your kids or your spouse.
Which is precisely why that paradigm shift to crisis prevention is so critical. You aren't buying insurance at this stage of life to make your family wealthy. You are buying it so they don't have to drain their checking accounts or put a funeral on a high-interest credit card just to lay you to rest.
So if the gap is that massive and the government clearly isn't coming to save the day, why do so many people over 60 just ignore it?
Well, there are a few reasons.
Because the guide highlights a bunch of rationalizations people use to avoid dealing with this. The biggest one seems to be people assuming they've just aged out. They think, oh, I'm in my 70s, nobody is going to insure me now.
Right. Age is the primary barrier, but it's a perceived barrier, not a real one. The reality is that age alone does not disqualify you. The insurance market is highly segmented. People in their 60s, 70s, and even into their 80s can routinely qualify for coverage. The types of policies change, sure, but the door absolutely does not close.
But then the natural follow-up to that is the cost. People think, sure, maybe they'll insure an 80-year-old, but the premiums are going to be astronomical.
And that ties into a really fascinating piece of behavioral economics. Research shows that consumers typically overestimate the cost of life insurance by a factor of 3.
Wait, 3 times. So if a policy actually costs $100 a month, they are walking around assuming it costs $300 and they don't even bother applying.
Precisely. They price themselves out of the market in their own minds without ever looking at the actual data. The numbers from Gruene Insurance Group show that a $10,000 to $20,000 final expense policy can run as little as $50 to $100 a month.
That's incredibly reasonable.
It is. We are talking about the cost of a couple of streaming services, or maybe sacrificing one casual dinner out a week. When you look at the actual math, it is entirely manageable for most retirement budgets.
Okay, so what does this all mean for the folks who say, I don't need to pay $50 a month? I have a solid nest egg. I've got mutual funds. I've got savings. My savings will easily cover an $8,000 funeral. I hear this argument constantly.
Oh, it's a very common stance, especially for people who have been fiscally responsible their whole lives. But it completely misunderstands the purpose of that accumulated wealth.
Right. To me, using a carefully built legacy to pay for your own funeral is like breaking open a piggy bank meant for your grandchild's college fund just to pay a parking ticket. You worked your entire life to build that wealth to pass on.
That is a brilliant analogy. If you force your family to liquidate hard-earned savings to pay a funeral director, you are directly draining the legacy you intended for your spouse or your grandchildren. An insurance policy protects your assets. It creates an immediate injection of cash so that the wealth you spent a lifetime building stays exactly where you intended it to go.
And even if your kids are fully grown, successfully established in their own careers, and don't rely on your money at all, it's still not about replacing income for them. It's about ensuring they inherit a clean legacy, not an immediate shared financial liability that they have to awkwardly negotiate splitting among siblings.
Exactly. Nothing ruins a family dynamic faster than a surprise $10,000 bill. So once we clear away those behavioral hurdles, the false assumptions about age, the overestimation of cost, and the misunderstanding of what a nest egg is actually for, we can move into the actual mechanics of how to solve this.
Yeah.
Because as we establish, the options after 60 are surprisingly robust. They just become highly specialized.
Yeah, let's dive into those options because I want to make sure we understand how these tools actually work. If someone is listening and they just want to solve that core problem, covering the basic $8,500 funeral costs so their kids don't have to, where do they even start?
The foundational tool for that is final expense insurance. It is essentially a small, highly targeted whole life policy. The coverage amounts are usually quite modest, typically between $5,000 and $30,000.
Okay, makes sense.
And what makes it appealing is its stability. The premiums are fixed forever, the policy never expires as long as you pay the premium, and crucially, there is no invasive medical exam required, just a basic health questionnaire.
Right, and to ground that in real numbers from the guide, a $10,000 final expense plan for a 65-year-old woman runs roughly $75 a month.
Mhm.
For a 75-year-old man, it's about $113 a month.
Exactly. Very predictable.
But what if someone has a broader need? Say they're in their early 60s, still relatively healthy, and they have an outstanding mortgage they want to ensure is paid off so their spouse gets the house free and clear.
For a broader, more substantial need like that, you would look at traditional whole life insurance. This offers much larger coverage amounts, anywhere from $10,000 up to $1 million or more. But the defining characteristic of whole life is that it builds cash value over time.
Okay, stop right there. Cash value is one of those industry terms that gets thrown around constantly, but it feels like nobody ever actually explains what it means. Can you break that mechanism down for us? How does it actually work?
Sure. Think of cash value like a built-in tax-deferred savings account that is permanently attached to your life insurance policy. When you pay your monthly premium, the insurance company splits that money. One portion goes toward the actual cost of insuring your life, the death benefit.
Right.
The other portion gets deposited into this internal savings pot. Over the years, the insurance company invests that pot, and it grows with a guaranteed rate of return. Eventually, you can actually borrow against that cash value while you are still alive, or even use it to pay your premiums if money gets tight.
Oh, wow. So it's not just a payout when you die, it's a living, growing asset you actually have access to.
Exactly.
That makes a lot of sense. But building that kind of asset obviously requires higher premiums. What if someone just needs coverage for a very specific, limited amount of time?
That is where term life insurance comes in. Term life is purely temporary protection. It usually lasts for a specific period, say 10 or 20 years. Unlike whole life, it does not build any cash value. If you outlive the term, the policy simply expires and you get nothing back. But because of that specific structure, the premiums are drastically lower.
And here's where it gets really interesting. The cost difference is wild. The source provided a sample rate. $250,000 of coverage for a healthy 60-year-old male on a 20-year term is only about $70 a month.
Yeah, it's a huge difference.
$70 for $250,000 in coverage. Why is it so incredibly cheap compared to the other options?
It basically comes down to actuarial science and mortality curves. Insurance companies know the exact statistical probability of a healthy 60-year-old passing away before they hit 80. And frankly, the odds are in the insurance company's favor that you will outlive the policy.
Ah, I see.
Because the risk of them actually having to pay out that $250,000 drops to absolute zero the day the term expires, they can offer massive coverage for a fraction of the cost.
It's pure statistical probability, but that naturally raises the biggest fear people have. I mean, what if you aren't a healthy 60-year-old? What if you've survived a heart attack or you're in remission from cancer and you've been declined by every traditional underwriting process out there?
The industry actually has a structural safety net for that exact scenario, known as guaranteed issue life insurance. And the name is literal. There are absolutely no health questions. There is no medical exam. If you apply and meet the age requirements, your acceptance is completely guaranteed.
Okay, I have to push back on this because insurance companies are highly calculated financial institutions, right? They're not charities. If they are guaranteeing a payout to someone with severe health issues and asking zero questions, the financial model should collapse. What is the fine print here? What is the catch?
You are absolutely right. An insurance pool would instantly collapse if they offered immediate full payouts to anyone, regardless of health. The mechanism they use to protect the system is called a graded 2-year benefit.
And what exactly does a graded 2-year benefit mean in practice?
It means that if you purchase a guaranteed issue policy and you pass away from natural causes within the first 24 months of holding that policy, the insurance company will not pay out the full $10,000 or $20,000 death benefit.
Okay, so what do they pay?
Instead, they will refund every single dollar you paid in premiums to your family, plus a guaranteed interest rate, usually around 10%.
Oh, so the family doesn't get the huge windfall, but they don't lose the money either. They get back what was put in, plus a little extra.
Correct. But the moment you survive past month 24, that full death benefit locks in completely. The graded period prevents people from buying a policy on their deathbed, which protects the financial stability of the insurance pool. But it still provides a guaranteed mathematical avenue for someone with severe health issues to eventually secure coverage. It proves that the market has engineered a specific solution for literally every health profile.
That is a brilliant mechanism. Okay, so we've thoroughly covered the tools that pay cash directly to your family. But the Gruene Insurance Group guide introduces another concept that fundamentally changes the logistics of everything we've talked about so far. It's called pre-need or burial insurance.
Yes, this is a big one.
And I want to play devil's advocate here for a second. If I have a final expense policy that is going to hand my kids $15,000 in cash, why do I need a separate, highly specific policy just for the funeral home? Can't my kids just use the cash to pay the funeral director?
They can, but relying solely on cash payouts ignores the brutal reality of the 48-hour window after a passing. When you leave a traditional death benefit to your children, there's a process. They have to claim it, provide a death certificate, wait for the funds to clear.
Which takes time.
Exactly. And in the meantime, the funeral director needs payment. Accounts might be frozen in probate. And more importantly, your grieving, exhausted children are suddenly forced to make dozens of rapid-fire financial and logistical decisions about caskets, services, and venues while they are at their absolute lowest emotional point.
It's essentially a recipe for family conflict and overspending out of guilt.
Precisely. Pre-need insurance operates on a totally different track. Instead of paying your family a lump sum of cash later, it pays the funeral home directly, immediately. You work with an agent and the funeral home ahead of time to select your exact services, and the policy ensures those specific services are funded.
So the guide highlights 4 pillars of pre-need, right? It takes decisions off the family, it complements existing coverage, it fills the $0 Medicare gap, but it also physically locks in the price against inflation. How does an insurance policy stop inflation? Like, if I buy a policy today and a casket costs 3 times as much in 15 years, how does the math work?
It works through a contractual agreement between the insurance company and the funeral home. You buy the pre-need policy today to cover today's cost of $8,500. Over the next 15 years, that insurance policy's internal value grows.
Okay.
The funeral home agrees by contract that they will accept the final payout value of that policy as payment in full, no matter what happens to inflation. The insurance company's investment growth essentially absorbs the shock of inflation, so your family never sees an extra bill.
That is incredible. I mean, it's basically like an all-inclusive prepaid fast pass for the worst week of your family's life.
That's a great way to put it. And if we connect this to the bigger picture, it leaves whatever traditional life insurance you have completely intact.
Yeah.
Your family gets the life insurance cash to inherit, and the funeral home gets the pre-need policy to cover the logistics.
Right. And the source material provides a really stark real-world scenario to highlight this. Let's look at this retired 68-year-old school teacher.
Right. So she's on Medicare, has some modest savings, but hasn't set up any specific end-of-life coverage. She passes away unexpectedly. Without a plan, her children are instantly thrust into chaos.
Right. 48 hours later, her kids are sitting in a funeral director's office. They are sleep-deprived, overwhelmed, and grieving. And the director hands them a bill for $9,200. As we established earlier, Medicare pays $0. Social Security pays that laughable $255.
Yeah.
So suddenly, these grieving siblings have to scramble to figure out how to split an $8,945 bill right there on the spot. It is deeply traumatic.
Now rewind the clock. Imagine if 3 years earlier she had sat down with Gruene Insurance Group and set up an $80 a month pre-need policy. She calmly chose the service she wanted, selected the details, and locked in the price contractually.
Okay.
When she passes, the logistics are entirely different. Her children make exactly one phone call to the funeral home.
And what happens? They just take over.
Exactly. The funeral home pulls the file. The funds are automatically transferred via the policy. The decisions have all been made. The children aren't asked to open their wallets, and they aren't asked to guess what their mother would have wanted. They are simply given the space to grieve.
Wow. It transforms what is usually a chaotic financial emergency into a quiet, managed transition.
It really does.
Okay, so we understand the mechanics. We know exactly what the tools do. The final piece of this deep dive is the action plan. How do you, the listener, actually execute this? The guide lays out the steps, and the very first one is arguably the hardest psychological barrier of all having the conversation with your family.
It absolutely is the hardest step. In our culture, we tend to treat death as a failure or a taboo subject
Hmm.
rather than, a biological certainty. People over 60 often avoid this conversation because they feel like bringing it up will unnecessarily burden their children with sadness or anxiety.
Exactly. It feels so morbid. You can't exactly slide this into a Sunday barbecue, right? Like, hey, pass the potato salad. And by the way, when I drop dead, here's the binder. How do you bridge that gap without making everyone miserable?
Yeah, you definitely don't want to do that, but you reframe the entire premise of the conversation.
Yeah.
You don't make it about death. You make it about logistics and love.
Logistics and love. I like that.
Right. You
Yeah.
tell your children, I was doing some research recently, and I realized how incredibly complicated things can get for families when someone passes. I refuse to leave you guys with a logistical and financial mess while you are trying to grieve. I am organizing this now so that you never have to worry about it.
Oh, that is so clean. You frame it as a protective measure for them.
Exactly. When you frame it as an act of protection, the resistance drops. You are enduring the temporary discomfort of an awkward conversation today to spare them the permanent trauma of a chaotic aftermath later. That is what critical thinking looks like, acting before the crisis, not during it.
I really appreciate that framing. So once you've broken the ice, the next step is to take stock of your reality. Look at the coverage you actually have. Does it realistically cover that $8,500 minimum without draining your hard-earned savings?
You need to know the gap.
Right. Find out exactly how big your personal coverage gap is. And if you don't know how to do that or you don't know where to start, you reach out to the experts. The folks who provided our research today, Gruene Insurance Group, actually mapped this out for people.
Yes, they do.
You can find them at grueneinsuregroup.com. That's Gruene insuregroup.com. Or call them directly at 210-986-7103. And they are licensed across a bunch of states: Texas, Arizona, Florida, California, Oklahoma, and West Virginia, serving everywhere from San Antonio to Beaumont.
And as people take those steps, there's one final critical rule regarding timing that we have to talk about. It addresses the procrastination instinct. People constantly tell themselves, I understand this is important, but I feel fine right now. I'll deal with this later when my health starts to slip.
Yes, the ultimate delay tactic.
It is a dangerous game to play. The absolute best time to secure any form of life insurance is today, while you are healthy. Trying to buy life insurance after a major diagnosis, whether it's an oncology report or a cardiac event, is like trying to buy fire insurance while you can actively smell smoke in your kitchen.
Wow, because the risk pool has fundamentally changed.
Exactly. As we discussed with Guaranteed Issue, the door doesn't completely slam shut if you get sick, but the moment that diagnosis hits, the door starts closing rapidly. Your options shrink, the cash value benefits disappear, and your monthly costs skyrocket. You lose all your leverage. Do not wait for the exact moment you realize you waited too long.
That is the perfect way to contextualize the urgency. Smelling smoke in the kitchen changes everything.
Well, that brings us to the end of our deep dive into the realities of life insurance and end-of-life planning. The ultimate takeaway from all this data is clear. Taking control of your final chapter is not an act of surrender. It is incredibly empowering. It is absolutely not too late to put the right tools in place. No, it's not. And I want to leave you with a final thought to mull over, something that connects everything we've discussed today.
Let's hear it.
Consider this paradox. If we're willing to spend 40 agonizing years of our lives meticulously planning the financial trajectory of our retirement, why has society completely normalized leaving the final 48 hours of our legacy entirely unmanaged? Perhaps true financial independence isn't just about dictating how you live your life. It's about ensuring you dictate exactly how your story concludes.
Dictating exactly how your story concludes. I love that. So take control of the narrative. Don't leave your checkout process to chance, and certainly don't leave your family holding a massive bill with nothing but a 3% tip from the government. Take that first step. Endure that uncomfortable conversation and get your plan in place.